Hello and welcome to the first ever Beckett webinar. I think it's important to first say how I hope all listening, their friends, family, loved ones are safe and well. Today, I, Dominic McLaughlin, will be presenting. I'm head of the investment committee at Beckett's, and we have Mr. James Thompson, my co-director, as a panelist who will be answering questions at the end, and our operations manager, Mr. Andrew Walsh, who will be assisting with what is hopeful the smooth running of our first webinar. Within the tools on Zoom, there is a Q&A section. And so if you do have any questions, please feel free to ask those there. We'll touch on all of those at the end of the webinar. We hope that these webinars are useful for people. If so, we're definitely going to look to run more during the lockdown, but also potentially afterwards. I have to say, on my side, I am really looking forward to the end of the lockdown for the ability for us to see people face to face again and welcoming old and new clients to Beckett House. For those of you who do not currently work with Beckett, we are a chartered financial planning practice based on the beautiful Fylde coast, but advising clients across the UK. We have been focusing in the past few years on really working out what drives us, our goals for our clients, and we put the attached mission statement together to try and help articulate this and put it down on paper. Now, whilst we have 20+ year history, we are actually a really young set of planners and team, supported by a great and experienced number of board members and advisors. We've got a real drive to push the profession forward and become what we believe could be the best small bespoke financial planning practice in the UK. But enough about us. Today's webinar is a starting one, and its focus is looking at generally how investment markets are moving, ultimately what is driving markets, looking back at what does history tell us and what can we glean from that, and then an idea of what is next, what are the pathways forward. Okay, so if we consider where we are right now, the world is either in or moving into a recession phase, which is this phase of the general economic cycle. And we don't know whether this is a short-term section of an economic cycle or part of the greater long-term run of an economic cycle, but it's important to demystify a little bit the word recession. I know a lot of people are really worried and terrified by the word recession, but it's just a technical term for how we measure economic growth. And again, economic growth is then measured by GDP, gross domestic product. We're definitely going to hear a lot about gross domestic product over the upcoming days, weeks and months in the press. So I wanted to just touch on that here. And unfortunately, with most things in financial planning and financial services, we can overcomplicate things. GDP is measured in 3 different ways. But the most common of these is spending. So this is a calculation of what everybody spends. This is households, businesses, governments, the combination of imports to exports, and adding all of this to provide us with a figure. And analysts will be really looking at these numbers, over the upcoming days to see how the short-term market movements may be affected. And getting back to a recession, this recession section here are 2 consecutive negative figures of GDP. And these are assessed against the previous months and seasonally adjusted. And so how we come out of lockdown is going to affect GDP, and it's going to affect this bottom phase of the cycle, what can often be referred to as the slump. The second graph on this page is just the FTSE 100 going back to the mid-80s. And the main thing here, and we've just popped it in, is there were multiple crashes that have occurred during this time period. Market corrections, bear markets, whatever we want to call them. But the most important thing to remember is that the trend is upwards. And it's really especially important in times like this to remember that. So moving on, if we start to think about what actually drives markets, it is really quite simple. The short-term movements in markets are driven by people. They're driven by sentiment, by feelings. You know, what is a market? A market is two people, one buying, one selling, and agreeing on a price. And that doesn't matter if it's the FTSE 100, the S&P 500, the top 500 companies in the US, or your local market. It's the same thing. And short-term market movements are based on these two factors: fear and greed. And what CNN Money do is they put together this this index, this analysis of where sentiment kind of is at the moment. They use 7 factors, some of which are stock price momentum, price strength, volatility, how quickly markets are moving up and down, the demand for safe haven assets. So in the UK, that's loans to the government gilts, loans to the Treasury in the US, and cash equivalents. And so they do this to build together an index to show where sentiment is at the moment. And it's important to see, you know, a month ago, as the pandemic was really starting to move and to increase, we were at a point of real extreme fear. And this is very common because it was not just a normal market movement, but it was one induced by a health scare, which adds fear just generally. But what we can see as time has moved on, we've moved a week ago to a number of 42, and I can tell you a couple of weeks ago it was closer to 28, 27, and now we're at 44 now, showing a general reduction in the level of fear in short-term markets. And a year ago, we were running over here at around about 70, which was pushed forward by greed, by the goal of making more money, more profits, more return. And I put this in because it's really, really important to distinguish between markets and the economy. Economies are much slower moving. They're oil tankers that take a long time for numbers to feed in and things to happen. And markets, while directly linked to economies, actually move a lot faster. They're the speedboat compared to your oil tanker. They move on anticipation of news, and therefore you often see things happen much more quickly in markets than they do in economies. And it's a really important thing to decipher between. With economies, you can have consumer confidence indexes, lots of other indexes along those sides, but this fear and greed index is a good one to look at short-term movements. And so moving forward, we wanted to look at the economic cycle in more detail. And with the concept coming from another planner, a man called Andrew Nealon, we put together a more tongue-in-cheek kind of diagram, but one that tells a really important story. And we used emojis to try and position people's feelings during the general economic cycle. And it's clear that in rising markets over here, people feel on top of the world. No matter what they buy, it goes up in value. You know, you're world beaters. But then as soon as markets start to dip, different feelings come in, you know, worry, sadness, frustration, stress, and even despair. And what it is it's really important to be the successful investor, to understand that markets move in cycles. This has always happened, and to not let your emotions overrule your investment decisions. Stay consistent throughout this, and the end goal will be proven. You will get to those goals that we're aiming to achieve. I know it sounds really boring, but it really is the way to go to make sure you don't shoot yourself in the foot in this phase by potentially overselling or even overbuying in the top phase. Stick with your plans and the end goals will be achieved. So if we start to look back into history, what can history tell us? What can we glean from previous events? And this slide looks at the bear markets. The market's declines. It's just another word for a market decline, a bear market, a market correction, a market crash. There's lots of different phrases that are used, but this goes back to the mid-40s. And they last for on average a year, and some of the largest falls have been about 60% from peak to trough, from the top to the bottom. And we're talking about the S&P 500 here. We use this, the top 500 companies in the US, because it's a good indicator of the global markets. It also has a lot of analysis done around it, so we get some really good graphs and work done on that. But what's strange, and the reason I brought this up is not that we're in a bear market now, but the fact that we've not had one for 11 years. They usually come around more often than that. So that's the point. Where we are now is not unusual. Yes, it's unusual circumstances, but the fact that we're in a bear market is far from unusual. We've had one of the longest bull runs, market expansions that we've ever had. And it's really important to look at that, to understand market expansions. And this next slide for me is just a really, really good example of this. It shows market expansions and how powerful they can be. So what we do is we run from the early 40s actually all the way through until close to present day. And you can see here, these are the negative market recessions, and these are the incredibly powerful market expansions that happen post-recession. And if we look at this, just touch on a couple. Some of the worst seen was 1972 to 74. This was fueled by really strong growth in the 60s. We'd had some brilliant years there, but there was actually an oil embargo. So the opposite to what's happening now. There was a reduction in supply of oil, which pushed prices up and really caused inflation and hurt growing businesses. There was also scandals. There was Watergate, and this pushed down consumer confidence. And then in the UK, we had the miners' strike and the banking crises. So, if you put all of those things together, it's a really, really torrid time for the economy and worrying times for investors. But the most important thing to take from this is that over the preceding 13 years, from here to here, we then saw 845% returns in the S&P 500. That is going back quite a while, 1974. But if you look over here, we've also got the global financial crisis. And this was, brought about by the post-internet boom. We'd had some really, really solid years there. And then you had a housing boom as well, fueled by banks really releasing borrowing and debt increasing and increasing. And then the financial institutions started to trade this debt, started to package it up so that it looked like, positive, safe haven assets. But actually, in fact, when the crisis hit, it was shown to be, almost toxic in many areas. And I remember the whole infrastructure of finances was talked about imploding. We were going to lose the banking system, lose the lending houses, losing the investment systems. And for me, the larger scale, longer term effects of that feel much, much worse than the shutting down position we're in at the moment. But nevertheless, and this is the point to take, is the patient investor, the consistent investor, was rewarded by 300% returns following the global financial crisis to February 2020. These things are important. This consistency is really important for people to take on board and appreciate. So moving forward, what does a good portfolio look like? And for many people, holding a single index, a single investment, and definitely a single company, and seeing huge swings, 60% down, 300% up, it's just not palatable, and nor would it fit with your investment goals. And also, we have no idea over the next 3, 6 months, even a year, as to what the next best returning asset class is going to be. And so core to our investment philosophy at Beckett's is diversification. And some of you may have seen this table before. It shows a range of different asset classes, and each column is a year, with the worst performing asset class ranked at the bottom and the best at the top. And what is hopefully clear is the lack of trend, the lack of pattern going on within the table. And whilst we do expect that equities will outperform bonds over the longer term, we don't know which equities and which years. At the end of 2018, we'd had a negative year of markets, and cash had been the best performing asset class. And if we're going to look forward into 2019, the year of Brexit, would we have bet that equities would have been the best performing, shares would have been the best performing asset class of 2019 when there was a lot of worry here in 2018? Potentially not. And this table itself is relatively crude because it doesn't break down into individual geographical areas. I can almost guarantee that I definitely didn't, and no analyst I spoke to guessed the best performing geographical region in 2019, which actually was Greek stocks. So, a 51.9% return there was probably not expected by many. And as such, it's really important for those long-term successful investors to be diversified, to manage risk and capture gains. Because the ultimate goal for Beckett's anyway, in terms of building a range of portfolios, is to build ones with different levels of risk, to build ones that can suit different investors' goals and objectives and risk profiles. And a single investor, myself included, I have different objectives and different risk profiles. I have a long-term objective of my pension savings, and I have shorter-term objectives for my children reaching different ages and different expenses coming around. And I will use a lower risk portfolio for my shorter-term investments than I will for my longer-term investments, which will be at a high aggressive level of risk. And what this graph shows on the left is what's known as the efficient frontier. It's a theoretical perfect line where you start with low risk assets on the left over here. Bonds are usually quoted with low levels of volatility, but also low levels of future potential returns, or lower levels. And then as you add risk to these, you move up the efficient frontier until you get to your highest risk investment, which will be likely to hold 100% of shares of equities. And it's the way you blend these two, the ratios, that this efficient frontier says, right, well, the perfect percentage should sit on this line. For every different little bit of risk that you're taking, every unit of risk you're taking, you're getting the maximum reward for that level of risk. And over here on the right-hand side, we now have the Beckett's portfolios, the 5 portfolios that we run in-house. And you can see here, for us, it's almost ideal the way that this is running, and they're almost perfect. These are the returns after all costs. And as markets were growing throughout February, you can see each different portfolio, and the higher risk assets are growing, the more aggressive portfolios growing more than the lower risk assets here. And this is same, and it's exactly what you would expect on the downside. When markets are performing poorly, higher risk investments will perform worse than your more cautious investments, which protect capital more. And then as you start to see a bit of a bounce, which we've seen, again, the lower risk assets grow, but the more higher risk portfolios grow more quickly. And the most important thing for us is that these portfolios rise and fall in line with each other. It's really important to be able to manage portfolios so different investors with different bespoke objectives can meet those objectives. So as a little recap on what we've been through so far, we're in and will continue to be in a recession phase of an economic cycle, be that a short-term one or a longer-term one. However, unlike other recessions, this was not brought about by a dampening of demand pre-recession or an overheating of the economy. Instead, it's been brought on by a health crisis. Now, the economy has effectively been put into what could be seen as an induced coma as we've been locked down. And we do not yet have detailed, widespread economic figures that we can rely on. And so markets are being driven by fear, mostly by fear at the moment. But time and time again, history has shown us that in times of stress, the patient, the diversified investors, they're the ones who are rewarded over the long term. So what is next? The question everyone really wants to know, but the fact is that nobody actually knows. I've been asked, are we at the bottom? Will markets fall further? What companies should I invest in right now? And the answers to these questions are unknown, at least in the short-term period. Not just by me or Beckett, but everyone. We're all searching for the answers. But until the numbers, until the corporate earnings start to come through, until the GDP figures start to come through, it's very difficult for anyone to base any decisions until we have the facts. So at the moment, we just don't know. And once these numbers start to feed through, we'll then start to see how the exit strategy is working, how removing ourselves from the lockdown will be. And that's going to be, essential to the way markets will react. So what might this look like? Well, what are the decisions likely to be based on? The assessment of fighting the virus can be seen in the different phases here produced by the World Health Organization. And different countries are going to make different decisions based on their localized assessments of the diseases. We have localized clusters here. So this is when we started to see it happening in Italy, in northern Germany, and then moving forward into that exponential growth phase that was talked about and we're hearing a lot about. And even more, we're hearing about the flattening of the curve of reducing the speed of the way that this virus grows. Hopefully then starting to reduce that deceleration phase, leading into phase 4, which is control and battling of any resurgences, stopping any phase 2s or any version 2s of the viruses coming out. And countries base their decisions on how to fight the virus on these different predominant measures that we can see over here. So at the moment, we're still in the physical distancing and quarantine phase. This is likely to continue to run to the end of phase 3 and maybe a little bit still into phase 4. Travel restrictions will run even further. It's unlikely that all airports across the world are going to be open as soon as we're out of quarantine. The effective use of personal protective equipment is likely to continue for a long time. Will we see in European geographical regions more common use of the face masks that they use in Asia? Will we reduce the amount that we do handshakes in the future and move to different ways of greeting each other? It will be interesting to see as humans how this has affected us. But important will be targeting and tracing that works, really positively to be able to analyze exactly what's going on and moving forward. And all of this is based on managing the healthcare capacity surge. This is why we're going into distancing and quarantining here. We haven't detailed at stage 5, which would be a vaccine, and that would completely change the process moving forward. And we do hope that this comes out. But in Europe, we feel we're probably moving towards stage 3 at the moment. And so how we restart national economies will be based on how effective we can exit these lockdowns. And analysts and market traders will be watching this closely. And by recognizing the differences among regions and sectors, governments can get people back to work faster, thereby safeguarding the economy even more. And the effectiveness of this will play directly into the recovery of these economies we're talking about. So we can see here from McKinsey and Company's assessment of how well we manage the virus as to how well economies will recover. And on the horizontal, the left to right over here, we have the economic policy that governments are imposing. And poor economic policy is listed here on the left, moving over to good economic policy over here on the right. And then the other one on the vertical axis, we have our public health response. So inefficient, no response really over here, leading through to better, more positive response over here. And that moves up and down on the axis. And we have to think that with the work already completed, the size of the fiscal stimulus that's occurred already, which is globally unprecedented, and the fact that there are green shoots in many, many different areas of the economies, that hopefully McKinsey and companies' assessments are correct. And they have listed these in order of likelihood. So A1 being the most likely, and A2 over here, the second, A3, A4. And what we can see is that we're seeing, this is the historical V-shaped, speedy rebound, the U-shaped economy. You can see the W over here. But these ones that are likely, we've tried to coin something. We were looking at these the other day, and we feel like it's a wobbly U-shaped. There might be some muted recovery in the world, yes. There could be a strong rebound over here, but both are going to come with that volatility as we come out of it. And this, remember, is an assessment of economies. It's not markets, which we mentioned earlier, will move much faster than this. So what do we do now? Well, as we've hopefully shown, history tells us that market recoveries are inevitable. Unfortunately, no one knows where the bottom is and when we're going to come out. But we do know that they've consistently happened, and those expansions can be incredibly powerful. And nearly all market analysts and commentators are looking at some sort of V or U or W, or as Beckett's have coined it, a wobbly U-shaped recovery. And all of those do lead to economic recovery. So it's important to stay consistent, stay patient, and stay diversified with your investments. And for the investment committee here at Beckett's, why investment philosophy matters. Well, we have seen since managing our portfolios, since the inception of them back in 2007, a number of market corrections, a number of market downturns, not just 2008, but different ones in 2011, 2015, the falls at the end of 2018, and now the global pandemic. And the ability for us to have a process and one that has weathered these storms and continued to produce excellent risk-adjusted returns at all different risk levels allows us to be confident in our decisions in these times. During this pandemic, we've consistently looked for opportunity to both protect portfolios and also to try and capitalize during this time. And more details of this can be provided in future webinars that we could do deeper dives into the portfolios if people are interested. But our mantra as an investment committee is to be measured and decisive with our actions. So in summary, I just want to close on, it is natural to be concerned about your finances in times of market stress. We appreciate and understand these feelings ourselves. But every element of analysis and research shows that no matter the event, economies and most importantly people bounce back. Both markets and the human race are incredibly resilient. And so please do contact your advisor if you want to understand more about what we're doing now or how your portfolio is positioned. And if you don't have an advisor, feel free to contact Beckett's. We want to speak to people. We want to help people with any queries that they do have. And even if it's just a day, taking a day off from the economics of it all, be assured that we're not taking days off. We are looking at this all the time, discussing it and filtering it into our thinking. So please stay consistent, stay patient, stay diversified, stay at home, protect the NHS, save lives. You can see it's been drilled into me. It's definitely linking to our own mantras over here. It's all really important, but yeah, these are the takeaways from this webinar. And to finish, before we delve into any questions, we will be sending out an email after this. It will have all of our details on, links to our social channels where we put snippets out. It will have a copy of the webinar and also some more in-depth look at maybe some of the different webinars we can look to do in the future. But right now, I'll hand over to Andrew, who can direct any questions there may be over to James, and I'll jump in where I can. Thank you very much for listening.
Thanks, Dom. Yeah, we have a question here, so I'll direct this to James. what do you think the hangover and impact will be of the crisis? And how do you think portfolios will help manage this change?
Yeah, I think it's an excellent question. I think Dom summarised very well that I think the exit from the lockdown will be key in the short term as to how the economy will react. I think there are things that as an investment committee we're going to be considering in terms of long-term returns, really. And is the world, the world that we move into, will it be a different world from the one that we've been in? I think undoubtedly there will be. I think the same is true of all crises that we've been through in the past. I think, on the back of 9/11, there was significant changes to travel, to immigration, to foreign policy. So I think it's important that as a committee, we are considering, some of the things that may change. So a bit like Dom says, really, it's two-sided. It's both protecting portfolios from any risks, but also, looking to see where we can capitalize. And, I think things like natural questions, and we don't have the answers at this stage, but things like, China, will China become a pariah state? Will there be a reckoning on the back of all of this to say, this is where it came from, but then on the other hand, they've kind of switched their focus now on becoming the global savior. And, if they are a big economy, and these are balances that we're going to have to, navigate through. Do we want to be involved in these areas? They might be high growing, but, if morally it's not necessarily the right decision, it's, that becomes quite tricky for us. We still like, we wonder if the world, the prospects of globalization, has that kind of taken a hit? Is it, should we be investing more in local, smaller companies? That's something we've been having a look at quite a lot over the last kind of month or so. Biotech, pharmaceuticals, is an obvious choice to be looking at. Is that something that we should be including? Technology is working from home, even to the extent that the office work become less prevalent? So do we need to be looking at our commercial property exposure? Retail, the impact on retail, will there be a kind of permanent hangover from this? So a good question. We don't have all the answers, but what I do guarantee is that, we're talking about it, and we will find the right way through this. Yeah, a good question.
Great, thanks, James. A couple more maybe on a micro level for clients and their portfolios. Got a client asking about their investment income. So wondering how their investment income may be affected in the context of market volatility.
Another very good question. I think what we see at times the income approach at Beckett's is very much a case of, we like our clients to retain an element of cash. So a cash buffer that allows them to, the reality is that when markets are under pressure and when portfolios do start to depreciate in value because of that, it's really at that kind of low point that we want to be avoiding, if possible, taking a withdrawal from the portfolio. So I think a lot of the income strategy comes through really good financial planning to say, let's make sure that we've got, a good source of income in that we can call on if we need to. The portfolios they're not necessarily arranged for income as such, which is what we'd call a total return, in that, what we're looking for from our portfolios is both a regular income that adds to the return, plus capital growth as well. And a lot of the return that we want to give to people is a combination of those two things. Now, clearly, both will have been affected. So I think it does come down to that kind of that starting point, really, that strategy that, we try to make sure that our clients, where possible, are holding some form of cash that can see them through. But, we think that, as things start to return to normal, you could argue that there's an incredible income opportunity in some of the investments that we're holding at the moment. And given that, it depends really if companies continue to pay a dividend, but the share price is a lot lower, then that dividend rate is at the moment a lot higher. But obviously we've taken some some fall to get to where we are. So I think a lot of it comes back to financial planning. Dom, anything you want to add there?
No, I think you're bang on there in terms of it comes back to financial planning. It comes back to that ongoing, regular reviews of the income strategy, of where the withdrawal rate sits. We've done a lot of work on safe withdrawal rates and how we structure the withdrawal, not just pensions, but all general investments. And it's the long-term drawing. When you breach what we call our guardrails, if you breach our bottom guardrail, it's not 1 month or 2 months that people need to worry about. And that's why it's really important when you talk to clients at the moment that they don't get too worried, because it's the short-term withdrawals don't make a huge difference, but it's about adapting your process and your strategy so then it runs over the medium term and then gets back to normal. We actually have done a lot of work on that in terms of the guardrails, and it's quite bespoke to us, our approach with this. So we can do more work on that, or even another review for people if that's of interest. But I think you've summarised it really well there.
Great, guys, thank you. I've had another question through that might just expand a little bit on the previous answer, so it may be a little bit shorter. But we've just got someone who's currently invested cautiously and thinking about their investment time frame. Do you feel it would be a good time to go up in the risk scale?
Do you know what? I've seen that, and I've actually with that. It's important to say that where a risk profile can be changed at any point, and we don't set these things in stone. It's very much a guide outset, and I can certainly see that point of view, that if you've been cautiously invested to this point, that there's a potential opportunity there to move outside of that. I mean, it takes a lot of consideration. Clearly, we're not for any second saying that we think we've found the bottom of the market. I mean, there's plenty of examples, plenty of scenarios in which we've plateaued for now, and we could drop down further. It's almost just as likely that maybe we have, and that there's more upside potential from here. So it would take a lot of considering, but it's certainly possible. And the way that the portfolios are structured on the platform is that it can be done quite quickly as well. I mean, we have the flexibility to do that. We've got the capacity. What I'd say is, whoever's asked the question, get onto your advisor and have a chat it through. Make sure that it fits with your goals, your objectives. But yeah, I can kind of see that. Can certainly see that point of view.
I think that's key. I think the main point that you mentioned there, James, was that it fits with your goals and objectives. It definitely feels like a long-term buying opportunity. For me personally, it definitely does. But it has to be in line with your goals, objectives, and your timeline. And your advisors will definitely be able to help you out with that. So yeah, get in touch.
Great, thanks, guys. James, you touched on one point there, which a client's asked in greater depth, regarding the evidence for potential major downturns in the near future. And so coupled with that, why do you think markets are staying at the current level? You mentioned.
Yeah, I think it's a real balance. I think it's a real balance at the moment. I mean, clearly, I think, this is the markets. This is what I'm gleaming from the markets, is that they potentially are now on the basis that, Dom alluded to it as fear, and fear is a word, but I'd also call it the unknown. And I think when the unknown is at a peak, then markets, we know this for a fact, markets hate, the unknown. And I think, going back to the end of February, early March, yes, fear was high, but it would coincided with the unknown being high as well. And I think it feels as though perhaps we're through that period of the unknown. We know, it's like the Donald Rumsfeld, isn't it? We know what we know, and we know what we don't know. We know what we know, and we know what we don't know. So it's the unknown factor has gone away to a certain extent, and the markets, feels a little bit more comfortable. there's green shoots, there's, Chinese factories, Chinese operations, even the US to a certain extent appears to be starting to talk about easing the lockdown. Europe, you're looking kind of Italy, Spain, Germany, again, just the rhetoric is all around that kind of easing. You've got this amazing monetary policy stimulus response. There's medical advances that was being talked about. I mean, I can't see any concrete medical advances, but every day we're hearing about, a task force on a vaccination or a test, that was previously for Ebola that's going to be converted, and all these types of things that gives the market a little bit of level of confidence. But then on the downside, we've not really been through any significant earnings reportings yet. So it's important to note that we've not really seen the impact on the corporate sector, which is massive. We could see, I know we saw Oasis Warehouse announcing more poor results. This is what I mean. It's on a bit of a knife edge as far as I'm concerned. There will be a hangover from this culturally, behavior wise, which we don't really know, which could force another slide. Then you've got overlapping all of this. You've got the oil and the oil price, and the collapse of the oil price, the dealings of OPEC and OPEC plus with Russia. You've got to think US and China, what kind of impact, those two are taking lumps out of each other for years, which had been driving the markets. And, I can't see them being particularly best buddies on the back of this, really. I think there's further fallout from that. So, then you've got, of course, government debt, so debt levels are going to go through the roof. It's going to mean higher taxes in the future. So, it is a balance between the two things. Those are the factors that are competing at the moment. And we're still, the UK was still 25% off from the high point. It's still a pretty significant discount, albeit it was 35% away. So the market's found some kind of equilibrium at the moment. And I think the push and pull of those various factors will see the market go one way or the other. And as Dom said, it's impossible to know. Nobody knows. That's why, we're talking about with cash. Anyone that's sat on cash waiting to come in, it's this drip feed, because we try and take some emotion out of it and try and put some regiment in there, and just some form of routine, and just say, right, let's just long term the opportunity is there, but in the short term we just don't know.
Yeah, so you don't see then kind of a counterintuitive relationship between the potential future economic downturn and the current consistency of the markets then?
Well, but we don't really know where the economy is going, to be honest. I mean, you look at, I think Goldman did a piece 2-3 weeks ago where they're saying, the likely impact Q2 this year is they were saying minus 25% on GDP. And I think reasonably consensus view is going to be somewhere around 30% contraction of I think this must be the US economy. But then they were saying Q3, maybe a plus 30%, Q4, another plus 30%. So, I think it comes back to this, is it V, is it W, is it U, is it wobbly U? The consensus is that there will be an economic recovery, just over what time frame and over and what shape it takes is still a bit of a question mark.
I would just jump in there. I think in terms of the counterintuitive side of it, the markets will always find a level, and what's really helped them find the level is the level of economic stimulus that's been put in. That has dampened, the worries most definitely, but they don't know. That's where we're at right now. We haven't had any of those corporate earnings. We've not had any of those figures coming through. And even when the first ones comes through, we're still going to be waiting on the second ones because they're not going to include all of the data. So markets will always find a level, and that's why they have done. I know we've got another question coming up about the US, and I would agree. I feel certain areas of economies feel overvalued, feel like they haven't been hit as hard, but actually the UK seems to have found its level. And I think the action that we've taken in the UK, or the UK government economically, has really helped provide that floor. But once these numbers come, then we can start to base decisions more on facts. And that's why we're uncertain as to whether we'll stay where we are, rise from where we are, or fall further. Because remember, the economy is different to the markets. The markets have already moved. The economy hasn't really moved yet. We'll start to see that when we see the numbers come through.
Great, cheers, guys. Yeah, so you mentioned the US there, and you've also name-checked a few other major powers at the moment. This from our attendee, with the US in some trouble, do you think that will mean a change in the world economic order? You've mentioned China and what's next to them, potentially the EU, you know, other major nations as part of that conversation. Do you think there may be a change in, you know, the top five?
I don't know is the answer. I think it's a great question. I did allude to it earlier on that, you know, these are factors that the investment committee, you know, we have an investment committee meeting on Thursday, and this is on the agenda. So it's not, what I can guarantee for people is it won't go without investigation, and it won't go without thought, and it won't go without potentially some form of action. It certainly appears that way. That, you know, but we know this. We know that US foreign policy has moved away from that kind of global savior, global guardian role to more isolation and I can't say it, isolation, shall we call it? You know, more protective. Protectionism is another word for it. But is that you know, a longer term trait, or is that actually, you know, the dominance of a single character, you know, in the Oval Office that's determining this form of policy? Because we've not even touched on that. I mean, let's go back to January before this transpired as a pandemic. You know, we're looking at, well, what's this year likely to be? What are the big questions this year? I mean, we were actually thinking we're coming close to the end of the current economic cycle, i.e. we were expecting interest rate rises, some form of inflation, looking out for bubbles in the market. Those were the areas. And then, of course, on top of that, you had a US presidential election. And those we thought were going to be the big kind of stories of 2020. And we've not even touched on the US presidential election, because that's coming up in November. I've not heard any or had any indication that that's likely to be cancelled. What we do know is it looks like a two-horse race between Trump and Biden. You know, obviously with Bernie Sanders dropping out last week. So the markets took some comfort from that, you know, because Bernie Sanders was very much talking about some form of national health NHS equivalent in the US, which the markets weren't particularly comfortable with. So, you know, you do have a presidential election coming up. Who knows that in November, you know, you have a Joe Biden-led administration, where the foreign policy changes again and the US kind of reverts back to the role that it's had. But they're absolutely correct that, you know, the US has kind of left that role of global guardian. You know, at the moment, China have stepped in, you know, during this pandemic, but will there be a reckoning after that says that there's a bit of a power vacuum there? And, you know, I don't have the answers, but it's on the agenda, that's for sure.
Yeah, on my side, I always I like to try and think in decades, and I think in terms of the question about, you know, which nation, is there going to be a change in the economic order? That's only going to occur over decade type time frames, and China will continue to ascend unless I'm less confident on the EU just because of the structure. These are just personal views, by the way. So for me, it's a US versus China battle to who will be the most dominant. And I don't think the pandemic will make any difference to that in the long term. I personally believe in capitalism. I believe that is what's going to drive things forward. So that's my two-piece on that. Thank you.
Thanks, guys. I think you did more or less cover some touch points there, but we have just had another question through.
Yeah, sorry, Andrew. I'll just say, yeah, I think I did answer that, Tim.
Yeah, okay.
I didn't see it, but it was. I think I kind of got there on that one.
You're preempting what our clients are thinking, James. What can I say? So there's a couple of questions about Beckett's and, you know, buying stocks and investments. So maybe you can offer some advice on potentially individual company stocks and trying to capitalize on undervalued stocks at the bottom?
I think probably at this point it's important to know that we're not stockbrokers. So our job really isn't to be we don't spend time considering individual company investments. So what the way that we invest is via what we call collective funds or mutual funds that buy the funds themselves buy a basket of investments. In a way, the fund managers then become our stockbrokers in that respect. So there's levels of risk management, levels of portfolio management within our portfolios. So our job really is to set the overall risk level, have that global asset allocation. Then in a way we kind of subcontract the stock marketing, the kind of stock decisions down, and then we review those fund managers on a regular basis. I think as a wider point, it's obvious that there is undervalued stocks, and we're constantly considering there's kind of two reasonably well recognized ways of investing in a basket of funds, one of which is called value, which is where you're trying to find those undervalued stocks. They used to be called opportunities, or special situations is another term that the industry imposes on it. So they call those value stocks, or these growth stocks, which don't necessarily have more of the kind of Warren Buffett style of buy a stock and hold it, a stock that you're willing to hold for the next 10 years, 15 years, 20 years, pick up the dividend, pick up a reasonable level of growth, and those kind of underpin the strategy. And the Beckett's portfolios have both. We have both value, opportunity. Now you could argue that switching more toward value and opportunity is something to be, I think at the kind of higher end of our risk spectrum, that might be something that again, it's on the agenda. These things are all on the agenda. So undervalued stocks, yeah, definitely something we're going to be looking at. Or something we have been looking at, but we'll be looking at again in the future. Perhaps more, further toward the cautious side of things. Yes, value can play a part, but we like growth in those areas, and we like the underpin of good dividend payers. So it's a balance really between those two things.
Thanks, James. We've kind of got excuse me, a twinned question along those lines. Someone else kind of also seeking, when the bottom is, and, effectively a buy low sort of strategy. If people are considering a further investment into a portfolio, what are your comments on kind of market timing and waiting until markets reach some sort of lowest points to then make the largest gain?
I wish we knew. It could be that we've been through the bottom. Taking the FTSE 100, it dropped below, intraday trading dropped below 5,000 points on the index, March 23rd, March 24th, now trading at 5.7, just under 5.8. So it's come back a long way from that particular point. It could, as I mentioned before, it's the balance between those factors mentioned earlier. It could slide back down further. That wouldn't surprise us. As I said earlier, if you're going to make a one-off decision, the Beckett strategy is not to make one-off decisions like that. We're not going to look to time this to try and time the bottom of the market, because we don't know where it is. So we would never give that advice if I'm being honest. Our advice is this drip feed strategy. We're looking at the moment at weekly drip feeds over a 6-month period. So we're talking about 24 equal tranches drip fed on a Monday morning into the portfolio, because we just don't know. Having said that, everything we do with clients is bespoke and is customized. So I'm running different strategies with different clients where it might be 3 months, so 12 equal tranches. If someone said to me, let's do 4 because I feel the next 4 weeks will represent, we'll discuss that and we'll talk about it, and if needs be, we'll agree it and move on with that. So there's no one answer that says this is the right time or this isn't the right time. And then I've got other investors that we talked about just delaying for a little bit further. It feels there's a fog. There is a fog, and will that fog clear, or will the fog get foggier? Who knows? And I can see both points of view.
I think on my side with regard to that is, like we said, we don't know that markets will drop, will increase, and even when they do drop, or even if they do drop, we then don't know that they're not going to drop further. So our drip feeding strategy has what we call a maximization overlay in it as well. So we look at drip feeding this money in, but there is a point in the market which we've not reached yet, which comes from our analysis, where for the longer term investors, we feel that the drip feeding effect no longer becomes beneficial and provides less protection. And actually, we just need to be fully invested now. So, like James says, it's bespoke to each individual in terms of how they see things. But holding off and waiting, I think you need to be in position, ready to move if you want to kind of run that type of strategy. And so again, we do that with new money coming into the portfolios. I can see the same. Can we still move money into the Beckett's portfolios? Can we still transfer pensions in? Yes, of course we can. We are actively doing that as things go at the moment. But we do look for indicators where being fully invested is more beneficial than drip feeding in and managing that risk. So yeah, that's where we're at the moment.
Thank you, Dom. I think just one more final question, unless any come through. James talked in his first answer about the potential changes of what life will be like. Do you think investment life will be different? Do you think there'll be a higher focus on more ethical investment strategies, on a worldwide sort of scale?
That's a very, very good question. I think part of me thinks that we've got to be considering that, definitely. That there could be. I think to me, so much hangs on whether there's a second rate of infection, because I think that if a lot of people predicting a V-shaped or a U-shaped, if that transpires, and that actually we return, there was talk of a vaccination in September, and the earlier that this thing is beaten and we've all got confidence to go back to the way that we lived, the more I feel as though the reality is we'll probably go back to some form of normality, and that things will return back to normal, including investment strategies, including, commercialism is commercialism, and that's, we're all here because we're involved in the capital markets, and those the capital markets will continue. Just in what format will they continue? I mean, the other thing is that if this thing rolls on and on and on and on, and there's different waves of it, and the vaccination isn't successful, then I think there will be a longer term change in patterns and behaviours that will affect the capital markets in different ways. So it all hangs on. To me, it hangs very much on this what I keep calling the hangover, or just the prospect of the ongoing situation. The longer it goes on, the more likely it is that we'll see some significant changes, whether that be more toward the kind of moral aspects of investing, the ethical impact of investing. I think the longer that the pandemic is around, the more likely that is.
Yeah, I'd agree. I think if anything, I think there is definitely a move towards, I don't know whether ethical is always the right word, but companies that show strong social governance, companies that show to care about the world, to care about the economy, but also people and society. I do believe that we are moving towards that. I think it's slow, and I think it has to come with positive economic returns. That is the end of the day. People need these returns to generate their living standards, and it is being shown that there are companies coming through, and the combination of their outlook towards society and their positive nature is feeding through into their results as well. And so as this becomes more and more prevalent, and things as people look for this, that only increases the demand in that sector, and thereby should increase the price. So I think we'll move more towards it, but I think it will become more of a mainstream screening that we have, or that the fund managers have, that we use on analysing their investments as a general process. But again, with a lot of these things, it will take time. It's not something that's going to happen overnight. The current pandemic may well have sped that up slightly, in my view.
Thanks, Dom. I think we're just about hitting the hour mark, so I think we will make this our last question now, which is from one of our attendees on Facebook, which is, do you think the 5-year investment horizons are a thing of the past?
No, I don't. I think it's probably as important as it's always been, and it's this focus on. I mean, I suppose if we all ask ourselves, where do we think we'll be in 5 years' time? Do we think the world will have advanced, or do we think the world will have? And I personally have a belief that the human, Dom touched on it in his presentation, the human race has a level of innovation, a level to want to just continue to move forward, and I mean, there's lots of obstacles in the way, but I think human invention, human innovation, the desire, I mean, that tends to find its way into capital markets, but it finds its way into other areas of the world as well. And I think really it's as important now as probably more important that actually we try not to get too focused on the short term, and that we have those long-term goals in mind, really. So I can see why the short term becomes much more important at times like this, but part of our job is to keep that focus on the medium to longer term.
And the goals and the objectives. I think everything we do at Beckett's is focused around clients' goals and objectives, and that then filters into your investment time horizons. So it's something that we do a lot of work on with clients in terms of, they may historically have been told or taught to advisors where, right, you now need to think about 5 years. In my view, you need to think about your life, your objectives, your goals, and how we can fit the investment structures to meet those. That's the most important thing. Brilliant.
Yep, thanks, Tom. There's no more questions. So any final thoughts? And I'll just thank everyone as well for attending.
Yeah, I'd just like to wrap it up. It's the first one we've done. Hopefully it's been useful and everyone's enjoyed it and taken something from it. If there are further questions, do email either your advisor directly or Beckett's at info@beckettsfs.co.uk. And thank you for tuning in.